Today, I'm gonna show you exactly how to use moving averages to spot profitable trades. Not the basic stuff you've seen before. I'm talking about actual strategies that make money. I'm Kunal Desai, and after teaching thousands of traders, I know exactly how to turn moving averages into consistent profits. When we are looking at a stock on the big picture, so that's your daily chart, there are only a handful of moving averages that I use that I think matter. I use the 9 EMA to signify my short-term trend. I use the 20 SMA for an immediate term look at things. And then I'll use my 50-day moving average to really get a gauge of the longer term trends and where we are in the stock on an overall big picture basis. What the heck is a moving average and how is it calculated? So guys, a moving average is used for two different purposes. Number one is to identify trends on different time frames. How do you do that? Well, you look at the slope of the moving average to figure out that term trend. So for example, the 9 EMA is the average price of your last 9 days. So when the 9 EMA is sloping higher, you have a trend that is going higher on a short-term basis. So if you look recently at Tesla, when it went from 360 all the way to nearly 500, what was it doing that whole time? Its 9 EMA was rising along with it, telling you that the short-term trend is higher, but that it's also very powerful. Then look what happened. When that 9 EMA reversed and crossed under the other MAs, all of a sudden the trend reversed on Tesla and it came to the downside. So how would we use something like that for our purposes? Well, if you're a short-term trader and you want to hold something for say a couple days and your 9-day moving average is pointing down, you would be trading against the trend. When would be the right time to add a stock like a Tesla? When the 9-day moving average is pointing up and it's going from 360 to 500? Or when the 9 EMA is crashing down and you're trying to dip buy, but the short-term trend has reversed and is on a steep downtrend? Well, look, if you tried to buy the dip at the wrong time, right? Bottom pickers, stinky fingers. It looks like a good deal at 450. It looks like a good deal at 400. It looks like a good deal at 350. When does the bottom stop, right? You don't want to ever try to bottom pick a stock. It's better to wait for that 9-day moving average to start curling its way back higher, telling you that the short-term trend has reversed. Your 20 and your 50 are your more intermediate and long-term trends. So if you're looking at something on a longer-term basis, like more of an investment basis or what we'd call a swing trade, you're going to take those moving averages into account. But for you short-term traders, really keep an eye on that 9-day moving average because it is going to save you a lot of trouble. Every time I have gotten myself into big trouble when I'm trading, whether it's day trading or swing trading, it's when I go counter trend. I look at a stock, it's crashing down, I'm like, wow, that's a really good deal. And then it keeps going down and down and down. At some point you just run out of money, right? And the same thing, I go counter trend on the upside. I think, wow, this stock is too extended, but that 9 EMA is just curling up beautifully and it's just following it. And then I'm like, wow, this thing should go down. It's a turd of a stock. And then boom, you get smoked out. So really be mindful of these moving averages. The second part and a second function of moving averages is support and resistance. Your moving averages can actually act as potential bounce points. So your 9-day moving average, for example, not only does it signify your short-term trend, but when you are in a steep trend, you can use your 9-day moving average as potential bounce points in a particular name. For example, in mid-November, if you look at the chart of Tesla, post-earnings in the election, Tesla goes on this huge rampage. And so what happens is all the chasers come in and these stocks get super extended. Now, the old me would say, wow, I've got FOMO. I need to take part of this stock, and you end up chasing it and you get smoked out. And this happens to everybody. The market counts on that. But what we want to be doing is when you get a first push on a stock, right? It's the first big push in a long time and you're clearing out levels. Always look left. That first pullback to the 9 EMA on that daily chart is an epic spot to start initiating or looking for a potential swing trade. So you start to pull back into that 9 EMA. When you get a green candle that holds there, that's your bounce spot. You put your stop loss right up under it, and then poof, you're playing it to the upside, and then you can ride that trend using your EMAs and your bone zone. That's your green shaded area on this chart. Guys, forget indicator overload. These are the only moving averages you need. The reason I use these specific ones is that it works. That's it. Anecdotally, built off 15 years of trading experience, trading as a young man into now an old man, right? Let's talk about some practical entry setups that you can do with moving averages in terms of how to spot trends. So I overlay moving averages not just on my stocks, but the actual indices. And what I find is that when the 9 EMA is over the 20, the trend is higher in the stock or the market. But what we can do is use that crossover to help time when the market itself has bottomed out and starting to trend to the upside. So if we look at May of 2024, you can see the shaded area is red. What that essentially means is the 9 is broken under the 20 and the short-term trend is down. And what I do to get aggressively long stocks or the general market is when that shading turns from red to green and opens up, what that means is the 9 EMA has crossed over the 20, and now that green shaded area opens up because the 9 is over the 20, and now you are in a bullish phase. And as long as that shading is green, I'm aggressive to the long side, meaning I'm going to do swing trading, I'm going to do day trading, I can hold stocks overnight, I can be more aggressive with my setups, because this is the time in the period where I can get paid, where the market is going to be more simple. So you can use these crossovers and the shading, which we just called the bone zone, to actually spot trends, but also when the trends shift. And if you are trading in the direction of this green and red shaded area, it will keep you out of so much trouble. This type of method can really help also with your risk management. When I'm trading in my longer term accounts, what I do is I start to level out and raise cash in my accounts when those trends start to shift to the red side, as I know that this is probably the time to take profits, and I don't get smoked out in trying to buy the dips till that trend starts to shift. So what you'll see is in July, like when the market starts to crash down, it keeps going, and you have this 1.5 month just nasty crash where look at the action on like Nvidia, Tesla, AMD, like all these stocks drop 20-30% when the market just shifts down 10%. And so you can use your moving averages in these shaded areas for risk management purposes too. So that 9 EMA can act as an awesome bounce point in the morning specifically. Don't do this setup in the midday. That's when you get yourself in a little bit of trouble, all right? The 9 EMA, because it's your short-term moving average, is primarily used in the morning. Guys, as day traders, it's our opportunity to just find a handful of opportunities every single day. Think about the gains you could do just using a simple setup like this in the morning. Robinhood, bounce off the 9 EMA. 10, bounce off the 9 EMA. Nvidia, pop, bounce to the 9 EMA, rip. Stock after stock will do this if it's got momentum. You don't have to have crazy strategies to make money. What you need is some simplicity and to be in the right names. And that's why I teach these strategies in our 60-day bootcamp, but then to those students, I trade live on Zoom so they can actually see me interact with these things, and I can alert them as I'm trading live and they can see it on Zoom. Let's talk about some common mistakes that happen to traders when they're using moving averages as a part of their strategy. So number one, most traders use their MAs wrong. They just blindly buy into moving averages when they see it. but they don't actually take it into context. So guys, a trade is not just a singular thing where you just buy off indicators. No trade should ever be bought because of an indicator. Indicators are used to confirm price patterns and price action. Another common mistake that people do with moving averages is they use them when a stock is just stuck in range or goes sideways. So if you look at a stock like this PLTR, right? For like months and months, it was just sitting here in the $6 range. And what do you notice about like $6, $8, month after month? What do you notice about it? Well, the moving averages are just crisscrossing around, right? So if you're like trying to use that as a bounce point, it ain't gonna work. Because moving averages need to have trends to be effective, because they're an identifier of trends. You need a trend for it to actually be able to be used for support and resistance, up or down. So anytime you're range bound, the moving averages will basically be invisible. They'll all crisscross around, indicating a trend confusion, and they will have really no value to it. So you need a trend. Look at coin right now. It's just been stuck at this like 270, 280, 290, 300 range for months. But look at what the moving average is doing, right? It looks like a heartbeat, you know, it looks like a heartbeat on the heart monitor. Like there's just no rhyme or reason to it because it lacks trend. So in absence of trend, do not use the moving averages. So the question then is, what do you do then? And what do you use in absence of trend? You do nothing, you leave the stock alone. Find something hotter where you can actually utilize some of these tools. Now you know exactly how to use moving averages to find profitable trades. Remember, these are tools, not magic indicators. You always want to build a case. Don't use them blindly. Always combine them with proper risk management. Now I have a strategy that I use called my ORB trading strategy. That is perfect to combine with these moving averages. And I broke down the entire trading strategy so that you can plug and play it right here.